depreciation expense. You can do the same thing with intangibles. So if you have trade names or something you have to amortize, you have the same accounts that you can set up. Okay. Plant, property, equipment's going to have a beginning balance. You're going to add any purchases. The best way to find this number out is look on your statement of cash flows. It will also tell you in the supplemental notes on the cash flow statement if they had any purchases that did not involve cash, but did maybe involve debt or equity. But again, they have to tell you what those purchases are. So the cash flow statement is a pretty good place of getting at. This is the historical cost. This is the cost of those purchases. Okay. The only time you touch this account is when you then sell, and the key to remember is you're selling its original cost. So this account, whatever goes in, comes out. So if it goes in at cost, it's got to come out at cost. So if I buy it at 100,000, it's got to come off at 100,000. What we recognize is you're going to have a net number because this is a contra account. So this is again going to be net. So on the balance sheet, you're going to have the net amount. In the notes, they will tell you how much of that is cost versus how much of that is accumulated depreciation. So this PP&E account is the cost that you originally purchased it at. It is not the fair value of it. It is the historical cost of what you purchased it at. Okay. The accumulated depreciation is about allocating the original cost as income, as expense. So the idea is to recognize that if I have a 5-year asset, then some of that is going to get used up over the next 5 years, and I'm going to move it to the income statement or to inventory if that would be the case. But the idea is I've got plant, property, equipment, 5 years, it's got to be moved over. So what's going to happen with accumulated depreciation is you're going to have a beginning number. You're going to add that depreciation allocation. And the only time this goes down is when you sell, and that would be the accumulated depreciation of what you sell. So these two numbers together are the book value or net value of what is sold. And then my depreciation number is how I get depreciation expense. Depreciation expense, and one of the easiest places to find depreciation expense is on the statement of cash flows because it's always an add back. It'll tell you right there, it'll tell you in the footnote, sometimes it'll be a separate line item, but you can figure out what depreciation expense is. The problems in your textbook are about, well, how do we actually calculate depreciation? And the way we actually calculate it, we focus on 3 methods. One is straight line. Another one is double declining balance, which, by the way, can actually be triple declining balance. It could be 1.5 declining balance. Double declining balance would be 2 over the life. 150% or 1.5 would be 1.5 over the life. Triple declining would be 3 over the life. Technically, you can use any declining balance. Taxes use double declining balance. That's why most companies use double declining. Straight line double declining, it could also be production, units of production, which tends to be used for natural resources, trees, timber, oil, and gas. But the idea is, again, you had to, in the textbook, figure out how to make these calculations. What you're trying to do is you're trying to come up with that depreciation expense. So notice the theme. With accounts receivable, you had 2 different methods of calculating bad debt expense. Percent of net sales or the aging method. With inventory, we had 3 different methods of, or 3 different methods of doing cost of goods sold. LIFO, FIFO, average. Here we've got 3 different methods of doing depreciation expense. Straight line, double declining balance, or units of production. In each of those cases, you're using an estimate to figure out your expense. All of these are estimates. You can choose any of the ones you want. You make different choices, you're going to have different numbers. at least in terms of inventory, they have to tell you which method you're using, and in terms of depreciation, they have to tell you which method they're using. Allowance, they don't have to tell you, but the other two, they do have to put in the notes, okay? You need to be able to do each one of these numbers, each one of these methods. So, straight line is cost minus residual, sometimes called salvage, divided by life in years. That's the straight line method. The production method is a variant of this. It is cost minus residual divided by life in units, which gives you $1 per unit, which is then multiplied by the units produced. So just recognize that all you're getting is a unit rate, and then you have to multiply by the units produced. I'd obviously have to give you units produced. There's no way for you to figure that out on your own. But notice, the only difference is it's life in years versus life in units. The nice thing about the production method is if I don't produce anything, I don't have any depreciation. Yeah.
Just wondering, you multiply by units produced on
Yep.
the, okay.
Yeah, so if I produce 1 unit, then it's whatever unit times 1. If I produce 10,000, it would be whatever that unit times 10,000. So units productions can be all over the place. That's why it's useful for something useful for natural resources. The natural resources are either there or they're not. So if I have timber, I think the easiest one to think about is if I bought, a forest for trees, and as I cut down a tree, each tree costs me something. When I bought the forest with the land, that tree cost me something, and as I cut down each one of them, that is the amount of units I'm producing. I'm taking the trees down, so therefore I'm recording depreciation expense as the trees disappear. If I don't cut any trees down, I don't have any depreciation. Whereas straight line method, you're taking the same amount every year, whether or not you are actually producing anything. So you could have a machine that's idle for 2 years because it's just not working really well. You'd still have to take the depreciation on it because we decided we're going to take a set amount each year for 5 years. The one that throws people off is double declining balance. That's because it is cost minus accumulated depreciation, not residual, times 2 over the life. This number will change, because this is book value, it changes every year, which means your depreciation expense changes every year. What you do in both of these methods, with the straight line method's really easy. Since if it costs me 120 at 20,000 of its residual, what I'm saying is I'm going to depreciate it down to its residual value. It's really easy to say. We're going to do the same thing here. You leave residual value in the account. So the idea is residual is what do I think I can sell it for when it's done. The idea here is you just leave it, so your last year you're going to have to plug it to get it there. That was the one where you always plug it to get there. But the idea is you're going to end up in the same place no matter which one you use. You're going to end up with residual amount over the life of the asset. But it's going to be different from year to year for each one of these. Yeah?
When you talk about your residual value, how are you determining residual? Is it?
The company decides what they think their fair value will be when they're done with it.
Okay.
So in other words, let's say you have a computer and you plan to replace the computers every 3 years. Technically, there's still some sort of value in a computer after 3 years. Not much, but there is still a value of computer at the end of 3 years. So the idea is, what could I sell that computer for at the end of 3 years? Now, you may have a piece of equipment that you bought, and you're like, this has got a 10-year life, but I only plan to use it for 5 years. So then what you figure out is, what's the cost? What could I sell it to the next person for at the end of 5 years? That's your residual. A lot of companies will assume that they will use a piece of equipment until it is dead. You know, they're going to bury it into the ground, in which case your residual is 0. So it's not unusual companies just to say, I'm going to assume residual is 0, and I'm going to use it as long as it's there, and boom. Okay. Other questions there? Okay. So we get our depreciation expense by calculating it. That gives us this, which means, guess what? You can back into what you sell. Purchases are given, ending is given, so you can back into these two numbers. One from this direction, one from this direction, so you can figure out what you sold at cost versus what you sell by accumulated depreciation. You can figure out the book value. Why that's important is gains and losses depend on the book value when you sell them. So what you have is a gain or loss will be the cash you receive, which, where would you find that? Statement of cash flow should tell you how much you received, okay? Cash received minus the book value. And that will give you your gains and losses, where book value is the cost minus accumulated depreciation at the selling date. So that's the number you kind of backed into. You can figure out the cash received from your cash flow statement. That'll tell you a gain or loss. If you're lucky, they'll give you the gain or loss. You can figure out the cash received and then maybe work backwards into the book value. But the idea is the gains or losses come from the fact that the cash you get is different than what's on your books. Yes.
Where are those recorded?
What the gains and losses will be on your income statement.
So under what account?
Typically under SG&A or other, depending on where they want to put it. A lot of times it's under SG&A, so it's a lot of times buried. But you can sometimes see it on the statement of cash flows because those are add backs. Because on the statement of cash flows, what we want to report is cash received, and if I've got a gain or loss on my income statement, I got to get rid of that so I don't double count it.
Right. So it would be on SG&A. It would be a credit, right?
Right, a gain would be a credit and a loss would be a debit. So they work like gains are revenues, losses are expenses, yeah.
So when you say at sell, you're not actually talking about the sell price. So I'm looking at my book value is whatever I paid.
At sell date, at the sold date,
Okay.
right.
So wouldn't that be just cost minus actual sell?
Yep.
Okay.
Accumulated depreciation. Now remember, your accumulated depreciation is going to change depending on which one of those three methods you're using. Yeah.
On the exam, we'll be doing it based on a full year, but,
Right.
but when a company's actually doing it, if they're selling mid-year, are they actually
Typically,
going to?
A lot of times what they do is, most companies use what they call a half-year convention, which is they take a half-year depreciation in the year of purchase and a half-year in the year of sale, and then they don't worry about when it's sold. Technically, you can calculate it to the day, you can calculate it to the month. There are some companies I know who will calculate depreciation to the month that it's sold. So, if I start in January, then I have so many months that I'm gonna put on the books versus if I start in November. Same thing with the sales, but a lot of companies just assume it's gonna be in there half the year on average, so therefore, half year in the first year, half year in the year of sale, you've got it figured out. Okay, the key to this one, and this is what we did with the case with Powfinger, was your cost is your cost. It's always gonna be the same cost. Your accumulated depreciation changes depending on which one of those methods you're using, which means your book value will be different depending on whether you're using straight line, double declining balance, or units of production. So if my book value is different, I'm either going to have a gain or a loss is a lot of times driven by the depreciation method I use. So what we did in the Powfinger case is we said, okay, assume, basically I think the problem was is assume the purchases you have this year, and you're going to do a schedule based on, and I do this on a couple of the homework exam problems, using straight line and using double declining balance. Then I say after the third year, suppose they sell it. In which case, what would the gain or loss be? Well, in one of the scenarios it was a gain, in the other scenario it was a loss because the amount of depreciation that you've taken. But if you look at overall, you take the gain and all your depreciation expense, or the loss and all your depreciation expense, it doesn't matter. It'll be the same amount overall, but from a year-to-year basis, it will be different. So double declining balance will give you lots of depreciation expense early on, which means you might end up having a gain if you sell it early because you took a lot of depreciation expense, but my book value is really low, I can sell it for a lot higher, I may have a gain. So if you take that gain and you match against that depreciation expense, it would be the same as if you took straight line, which has less depreciation every year, and you may have to take a loss in this situation. So in other words, gains and losses are about getting your accounting estimates correct. Your depreciation method was the estimate, so my gain and loss is just basically saying, well, what's on my books is not the same thing as the cash I'm selling it for, so let's just kind of even everything out, yeah.
So if it's gain or loss, is that taxable then,
Um,
or not?
in general, I mean, selling, buy, it depends on but yes, it is, because you're buying and selling something, the gains or losses can be taxed depending, on what's happening. But again, you gotta remember, even for tax purposes, you took depreciation already.
Okay, right.
So it's still, they're basically, yeah, it's still going to even itself out. And for tax purposes, you almost always get double declining balance anyhow, so you're more likely to end up having maybe gains, and they may tax you a little bit more because you took a lot of deductions rather than you should have. So the idea of gains and losses are not, oh, this person was really good, they sold it at a gain, or, oh, they sold at a loss, this must be a bad thing. It's recognizing that gains and losses are just getting the accounting back to cash flow. They don't really mean anything, except for getting your books right. Okay, so, the T accounts, the accumulated depreciation, capitalizing versus expensing, let me go back to that one. We've got, yeah, write-offs. Impairments is another version of write-offs, and we'll get to that here in a moment. I think we've got everything there. Okay, capitalizing versus expense.